Number 6. The averages must conform. One of the most important principles of Dow theory is that the movement of industrial average and the transportation average must always be considered together, that the two averages should conform each other. The need for conforming action by both averages would seem fundamentally logical, for if the market is truly a barometer of future business conditions, investors should be bidding up the prices both of companies that produce goods and of companies that transport them in an expanding economy. It is not possible to have a healthy economy in which goods are being manufactured but not sold, that is, shipped to market. This principle of conformation is shown in Figure 3.4. Figure 3.4 Dow theory requires both averages to conform. In example A, the industrial average is the first to signal a bear trend, point A, but the actual bear market is not indicated until the transportation average confirms at point B. Example B shows the beginning of a new bull market. Following a sharp decline, the industrials make a new low. A rally then develops, but the next reaction holds above the previous low. When price is pushed above the preceding rally, a bull signal is given by the industrials at point A. In the meantime, the transportation average makes a series of two succeeding lows. The question that arises is which average is correctly representing the prevailing trend. Since it is always assumed that a trend is in existence until a reversal is proved, the conclusion should be drawn at this point that the transportation average is indicating the correct outcome. It is only when this average exceeds the peak of preceding secondary at point B that a new bull market is confirmed by both averages, resulting in Dow theory by a signal. The movement of one average unsupported by the other can often lead to a false and misleading conclusion, which is illustrated in Figure 3.5, which shows the 1930 price action in a wave form. The 1929 to 1932 bear market began in September 1929 and was confirmed by both averages in late October. In June 1930, each made a new low and then rallied and reacted in August. Following this correction, the industrials surpassed their previous peak. Many observers believed that this signaled the end of a particularly sharp bear market and that it was only a matter of time before the rails would follow suit. As it turned out, the action of industrials was totally misleading. The bear market still had another 2 years to run. Figure 3.5 1930 example, the theory in action 1998 to 2013. Chart 3.1 compares the industrials to the transports between 1997 and 2013. The chart opens during the tail end of 1982 to 2000 secular bull market. The transports gave a non-confirmed sell signal in 1998 following a zigzag down. The industrials also broke to a new low, but since the previous July's high was above the April one, a strict interpretation set a non-confirmed bear market. Since the transports remained in a bearish mode until 2004, all that was required for a sell signal was industrial confirmation, and that came in October 2000. As this average broke down from a line formation, fortunes were reversed in early 2003 as the industrials went bullish, but the transports were unable to follow suit because they made a new low in early 2003. Point C. Unlike their industrial counterparts who were able to give an unconfirmed bull signal at point D. Consequently, it was not until the transports broke out of a line formation at point E that a new bull market was signaled. The next event developed at point F when the industrials broke below their previous intermediate low. The transportations eventually confirmed in November 2008 at point G. The subsequent bull market was signaled. Chart 3.1 Dow Theory Signal 1997 to 2012. Dow Industrials Buy or Sell Confirmed, Buy or Sell Unconfirmed. Dow Transports. So this is chart 3.1, sorry. A, B, D, F, I, C. Okay. Source Martin Pring's Intermarket Review. By the transports with a line breakout in early 2009, point H, and subsequently confirmed by the industrials in June at point I. This buy signal is arguably controversial since the intermediate correction only lasted for 4 weeks, acceptable but somewhat on the low side. Also, the correction retraced just 30% of the previous advance, 33.1 by 3 to 66.2 by 3 being the normal accepted limits. Additional considerations. Dow theory does not specify a time period beyond which a confirmation of one average by the other becomes invalid. Generally, the closer the confirmation, the stronger the following move is likely to be. I have noticed that this principle can be extended to other techniques used in technical analysis, especially in conjunction with momentum price consideration. Dow theory does not specify a time period beyond which a confirmation of one average by the other becomes invalid. Generally, the closer the confirmation, the stronger the following move is likely to be. Okay. I have noticed that this principle can be extended to other techniques used in technical analysis, especially in conjunction with momentum price considerations. For example, confirmation of the 1929 to 1932 bear market was given by the rail average just one day after the industrial average. The sharp 1962 break was confirmed on the same day. One of the major criticisms of Dow theory is that many of its signals have proved to be late, often to 20 to 25% after a peak or trough in the averages has occurred. One rule of thumb that has enabled Dow theory is to anticipate probable reversals at an earlier date is to observe the dividend yield on the industrials. When the yield on the industrial average has fallen to 3% or below, it has historically been a reliable indicator at market tops. This was certainly true prior to the mid 1990s and has been more questionable since then. Similarly, a yield of 6% has been a reliable indicator at market bottoms. Dow theorists would not necessarily use these levels as actual buying or selling point, but would probably consider altering the percentage of their equity exposure if a significant non-confirmation developed between the industrial average and the transportation average when the yield on Dow reached these extremes. This strategy would help to improve the investment return of the Dow theory but would not always result in a superior performance. At the 1976 peak, for example, the yield on the Dow never reached the magic 3% level and prices fell 20% before a mechanical signal was confirmed by both averages. In addition, the 3% top would have missed the mark by about 5 years in the late 1990s. Over the years, many criticisms have been leveled at the theory on the basis that from time to time, as in the period of war, the rails have been over-regulated or that the new transportation average no longer reflects investors' expectations about the future movement of goods. The theory has stood the test of time, however, as Table 3.1 indicates. Table 3.1 Dow theory analysis buy signal, sell signal, price of date of signal Dow. Oh, okay. When considering the results, note that these signals are the result of my interpretation. In some cases, with the benefit of hindsight, some Dow theorists would disagree with my interpretation, but none would dispute the fact that in general the theory works. Indeed, criticism is perfectly healthy, for if the theory gained widespread acceptance and its signals were purely mechanistic instead of requiring experienced judgment, they would be instantly discounted, which would render Dow theory useless for profitable investments. In any event, it is important to note that it is far from perfect, and in any case, Dow theory should be regarded as one indicator, that should be used with others in technical arsenal. Summary: Dow theory is concerned with determining the direction of the primary trend of the market, not its duration or size. Once confirmed by both averages, the new trend is assumed to be in existence until an offsetting confirmation by both averages takes place. Major bull and bear markets each have three distinct phases. Both the identification of these phases and the appearance of any divergence in the normal volume price relationship would offer useful indications that a reversal in the major trend is about to take place. Such supplementary evidence is particularly useful when the action of the price averages themselves is inconclusive. Chapter 4. Chapter 4: Typical parameters for intermediate trends.